Good morning. I'd like to call to order this special meeting, July 11, 2014, of the Columbus Municipal School Board. We do have a quorum that is present this morning. Next is item number 3, the adoption of the agenda. Is there a motion?
So moved.
It has been motioned by Mr. Spears. It has been seconded by Mr. Lewis. Is there any discussion? All in favor, please signify by raising your right hand. It is unanimous. The next item on the agenda is the 2014-2015 Columbus Municipal School District Budget Public Hearing. Mrs. McGarr will come forward and lead us through that.
Thank you, President Verdale. I would like to welcome each of you to the Columbus Municipal School District Budget Public Hearing. We appreciate your support of and interest in our school district. I'd like to extend a very special welcome to each of you. I want to publicly thank our Board of Trustees for their suggestions, questions, input, and comments in support of the development of this budget. We appreciate you and your work with our school district. I would also like to take this opportunity to thank Ms. Edna McGill and each member of the management team, as well as the principals and department supervisors. Their help was instrumental in the development of this budget. I would also like to thank my office staff as well, Ms. Evelyn Blunt, Aliska Dyson, Felicia Elmore, and Holly Rogers. I could not have done any of this without their help. And a special thank you goes out to Holly Rogers, our federal programs accountant, who put in many hours preparing the federal portion of our budget and helping out with the personnel side of our budget. We value your suggestions and comments and any input that you have. So we have provided you with an opportunity to give us your suggestions. We have provided you with an input form. And during our presentation, if you will just write any comments, questions, and our suggestions on the form, at the end of the presentation, we will collect those forms, and our board president, Ms. Angela Friedel, will read the questions, and we will respond to the questions that we can. And if there's something that we need to investigate further, we will do that as well and get back with you with a response. If you did not get a form, just hold up your hand and we will get you one. Okay. Okay, we'll start on our slide. On page 2 is our agenda. The purpose of this hearing is to provide you, the public, with information concerning our proposed budget. We will provide an overview, then we will present detailed breakdowns of projected revenues and expenses. This presentation includes budget highlights, revenue projections, expenditure projections, and a breakdown of the budget categories. Okay, on slide 3, you will see some general information. Our district will serve approximately 4,653 students in grades pre-K through 12th grade. Our elementary schools have a projected enrollment of 2,475 students. Columbus Middle School enrollment is projected at 978 students, and Columbus High School is projected to have 1,200 students for the 2014-2015 school year. Our average enrollment this past year was 4,510 students. We expect to employ 589 personnel. All positions have been accounted for in the budget. Projected staffing includes all employees of the Columbus Municipal School District. The student-teacher ratio will be approximately 25:1, which is in compliance with Mississippi Public School accountability standards. On slide 4, we have included a list of acronyms and what they stand for. We will be using these acronyms throughout this presentation. As you can see, MAEP stands for Mississippi Adequate Education Program. EEF stands for Educational Enhancement Funds. Both of these are funds that we receive from the state of Mississippi. IDEA stands for Special Education. QZAB, or QZAB, stands for Qualified Zone Academy Bonds. QSCB, or QSCAB, stands for Qualified School Construction Bonds. And GO bonds are the General Obligation Bonds. So you will hear all of these acronyms throughout this presentation. We will now go to slide 5. Our total revenue that we are projecting is $43,118,978. Revenue is made up of 4 different sources: local, state, federal and 16th section sources. And later in the presentation, we will show you what makes up each of these sources, the amounts for each, and the reason for any increases and/or decreases from the prior year. The majority of the increase I will share with you right now comes from our state sources, and this is due to an increase in MAEP funding that we received from the state of Mississippi for the proposed teacher pay increases. As you can see from the pie chart on slide 6, the majority of our revenue, as I shared with you before, is from state sources. And so in the next few slides, we will discuss what makes up each of the revenue categories. Okay, on slide 7, our anticipated local revenue for the 2014-2015 fiscal year is $13,051,249. Local revenue is made up of 3 categories: local ad valorem taxes, food service sales, and other local revenues. We are asking for a decrease in local ad valorem taxes at this moment in the amount of $188,437. In addition to our escrow amount from 2013-2014 in the amount of $121,104 and a decrease in homestead exemption in the amount of $57,218, we are asking for a total decrease at this point in time from the taxpayers of $366,759. And we will discuss our ad valorem tax request on a later slide, but I will tell you that this number is subject to change. We have one more month of calculation to figure into this, and that is for our receipt of our tax collections for the month of July, and we will be collecting those in August. And then also for the month of June that we will be collecting later this month, that will figure into our calculation as to what we will actually be requesting from the city for our ad valorem purposes. Food service sales were calculated based on the enrollment and amount of participation that we are expecting for our paying students. We are showing a decrease of $72,309 due to the fact that we are anticipating an increase in students that will be participating in free and reduced lunch. Because they will be participating in free and reduced lunch, they will not be paying full price, which means our local sources will decrease. However, because of a decrease in our local sources for food service, our federal amount that we receive for food service will increase. Our other local revenues, we are looking at a decrease of $307,587. Our other local revenue is comprised of interest on investments and all anticipated activity fund revenue at each school. We are anticipating a decrease in other local revenue because we will no longer be receiving funds for providing alternative school services to the Lowndes County students. On slide 8, we have a pie chart that shows that the majority of our local revenue is from local ad valorem taxes. On slide 9, we are showing our state revenue budget. We are proposing state revenues of $21,049,632. This is an increase of $642,196 from the prior year in MAEP. And that is because of the teacher pay raise, that amount that was funded from the state. The majority of our state revenue is from MAEP. Our school ad valorem tax reduction funds, we have not received these funds in several years. This is some money that was funded to us from the state of Mississippi in past years, and they have not funded this in the past few years. So we are not anticipating them to fund that for the next fiscal year either. Our homestead exemption, we are anticipating a decrease based on projections that we have received from the tax collector's office of $57,218. We are showing an increase in vocational education of $146,173, and this is projected based on what we have received in the past. Our other state revenues include rail car taxes, heavy truck taxes, rental car taxes, and our national board reimbursement. And we are basing this amount on amounts that we have actually received in the past. As you can see on the pie chart on slide 10, the majority of our state revenue is from MAEP. Next, we will go to our federal revenue section. Our anticipated federal revenue for the 2014-2015 school year is $8,998,097. Child nutrition accounts for the largest amount of federal revenue that we have budgeted. We are anticipating an increase of $465,920 in child nutrition revenues based upon a projected increase in enrollment and participation. More students participating in free and reduced meals results in an increase in federal revenue and a decrease in local revenue. Our other federal revenues include Title I, Title II, Title VI, and IDEA, which is special ed, and all of these we are projecting a decrease. And the reason is for that is because the amounts that were projected for the prior fiscal year had a large amount of carryover from the 2012-2013 fiscal year that went into that calculation. And we do not have that carryover going forward into the 2014-2015 fiscal year. Our other federal revenue amounts, we are showing a projected increase of $59,652. This consists of Impact Aid, TVA, 21st Century Community Learning Centers, and the Teacher Incentive Fund grants that we receive. On slide 12, you can see from the pie chart the majority of our federal revenue is from child nutrition funds, followed by Title I funds. Okay. On slide 13, this portion of the presentation explains our projected expenditures. We have projected expenditures of $44,418,149. Our expenditures are in excess of our projected revenues. However, there is a very good explanation for this. If you will turn to page 32 of your handout, I have included a spreadsheet that accounts for this difference. And I'll give you a few minutes to turn to that page. On page 32, you will see our proposed revenues of $43,118,978. Our proposed expenditures are $44,418,148. That leaves a difference over revenues under expenditures of $1,299,170. This difference is due to the following. In the general fund, our total revenues are $29,474,411. Our total expenditures are $29,870,832. This means that expenditures are in excess of revenues by $396,421. Now, if you add our other fund sources and uses to that, that is an amount of $172,917.28. This amount consists of indirect cost transfers into the district maintenance fund and transfers out of the district maintenance fund for athletics and our MDA loan. Our MDA loan has to be funded by the general fund because it is to be paid out of whatever fund saw that decrease from savings in retrofitting or lighting. And so that was the district maintenance fund, so we have to pay for that loan out of the district maintenance fund. Indirect costs are things such as utilities that cannot be directly attributable to a certain cost area. The State Department of Education gives us an indirect cost rate that we have to use in computing how much our federal funds owe our district maintenance fund for these indirect costs. Because these funds are being transferred into the district maintenance fund from the federal funds, instead of being received from an outside source, they are shown as an operating transfer in instead of revenue. Therefore, they're not included in the revenue amount. They are included as an other fund source. And so if you subtract that amount from that, you will we will be more in line with what our revenues are. And also, there is an amount that was authorized by the board to be paid out of fund balance for 3 buses that we are taking out of this year's budget. And so what happens with that, we take it out of the fund balance and increase our budgeted expenditures by that amount. That is $249,300. That is the price of $83,100 for 3 buses. So if you take the difference between the revenues and expenditures of $396,420, and you add our other fund sources, which is the indirect cost transfers of $172,917, and then you add the amount that we have increased our budget from fund balance to pay for the 3 buses in the amount of $249,300, our actual revenues and other sources exceed our budgeted expenditures by $25,797 for the general fund. The other difference comes from our debt service funds. Our total revenues for the debt service funds is $2,846,464, and expenditures are $4,436,284. This is a difference of $1,589,820. Our revenue for the debt service fund comes from ad valorem. In past years, we have collected more in ad valorem than we needed for our debt obligations. So we currently have funds available in our debt service funds. These funds are by law to be used only for the repayment of debt. Because we already have these funds in fund balance, we do not have to request these amounts in our ad valorem debt levy. Therefore, the budgeted revenue will be less than the budgeted expenditures. Also, any shortfall that we have from funds this year in our debt service levies, because we had funds available in those debt service levies, we won't have to issue a shortfall to cover those debt payments.
Excuse me, Ms. McGart, would you state that one more time, please?
Because we had funds available in our debt service funds, any shortfall, and a shortfall is when you do not receive as much as you requested, any shortfall in our debt service funds, we had funds available on hand to meet all of our debt obligations. So there is no need to borrow any money to cover shortfalls in those debt service funds.
And Madam President, if I might inquire one more thing, Ms. McGar. This is not, the funds you're referring to are not coming from district maintenance.
No, they are in separate funds.
Or some refer to it as the piggy bank.
Right, that's correct.
Okay.
Ms. McGar,
Yes.
I don't know if you've gotten to that part of your presentation yet, but I noticed that you said any shortfall. I know that a shortfall will not be issued, but do we have a shortfall?
We are anticipating not to receive everything that we asked for in our debt service levies, but we have funds available to cover those. However, in our operations, we actually are showing an escrow, which means we have collected more than what we requested for operations.
So we do not have a shortfall?
Not in our operations. We may be short in our debt service, but we have funds available on hand to cover that. So we will not have to declare a shortfall for those funds.
And I promise I will not interrupt any longer, but I just want to make sure that we are all understanding this point. A shortfall would be that we request X, we only collect Y, and it comes out to be the answer of Z. If you do that mathematics, that's going to come out the same way all the time. But if you say X minus Y plus C gives you Z, then you come out with our equation now. If you don't know how much money is in those, what I consider residue cash, in those funded accounts, you can't make that assumption. So therefore, you can look at X minus Y to come up with Z and make your conclusion, but you're wrong. And that's my point.
I'd like to clarify something also. It's my understanding that what we requested last year, that we're going to collect $212,180 less than what we requested, but you're saying that we have funds on hand to offset that. Can you tell me, how much do we have on hand? Do we have exactly the 212,000, or do we have something more than the 212,000?
I don't have those figures with me.
I
in
do.
here. Okay.
I have those figures. Where we will fall short in cash on hand for the 3 mil note, we have 113,000, and this is as of April 30th, so it's probably increased just a little bit over that time, but 113,709.43. The shortfall note for 2011, we have cash on hand 67,357.35. Qualified, or the QZAB bond, we have cash on hand of $1,625. And the general obligation bond, which is obviously our heavier one in the budget, we have cash on hand as of April 30th of $1,297,167.90.
Okay.
Which, if you were to look and say, well, we're going to ask for 2.8, and you add all these cash together, that's going to put us at being, as far as what we requested last year, that's going to the reason that we're not going to end up having a shortfall.
Okay.
Because in the past, people that, I won't get into the reasons of it, did not account for the cash that were in account, so we were just taxing the taxpayer, taxing and bringing in money and paying and paying and paying, but no one ever thought to look that cash is building up in these accounts to actually pay the debt. And so that's what we're doing this year. Is my understanding of looking at the finances is we're pretty much zeroing out those cash accounts so that we don't just continue to take more and more from the taxpayer and leave this money idling there and not actually being used.
Ms. McGraw, I got one more comment, and I'm going to try not to interrupt you again. But Mr. Lawson-Heiser just made a note that of the $212,000. I understand that X plus Y equals Z. I do understand that. However, I'm hearing, and I could be wrong, but I'm hearing we have a shortfall, but we do have the money to cover it so that we don't have to issue one.
That's correct.
Okay.
And we had money available on hand to make all of our debt payments. And when you look at it, a shortfall or escrow, a shortfall just means you didn't collect what you requested. Now, school districts there are many ways that you can work with that. You can take funds that you have on hand to cover that shortfall. You can issue debt to cover that shortfall. We have issued debt in the past to cover that shortfall. But we actually had cash on hand in those debt service bonds to cover that. We had cash on hand to make all of our debt payments and have cash left over to go into the calculation for this upcoming fiscal year. And so we have one more month. We have to give our levy request to the city before August 15th. We will have one more month of collections to figure into that. So we will go over this a little while later, but I just want to address it since these questions have come up. On the ad valorem tax request for debt service, the amounts for the debt service request will probably go down some because we do have one more month's collection coming in. So we don't want to request more than we need for these and put that undue burden on the tax collector. So what I did in figuring out what we need for debt service, I took exactly the cash that we have on hand and figured what we needed to make our principal and interest payment for the upcoming school year and any paying agent fees. And then I also went ahead and picked up any principal or interest payment that has to be made in the fall of the following year, because our tax collections, the majority of that money comes in the spring. And if we have a large principal or interest payment upcoming in that fall before we collect it, we'll have to take cash from other sources to make that. And that should come from the debt service levy. Okay. And so we go ahead and ask for that in advance. But I just want to assure you that we did have funds available to make all of our debt payments. We were not negligent in making any of our debt payments. And as far as a shortfall or escrow, operations, we are showing that we have collected more. Okay. And we will we have some more months before the city's fiscal year. So we've actually collected more in operations, but the debt service, some of those, we actually probably won't collect what we requested in those. But we won't know for sure until, later on. Is there any other questions on that?
The only other question, I just want to reiterate that the money coming to pay what might be considered a shortfall in wording, which is not in reality, is not coming from the district maintenance piggy bank fund, as some refer to it as.
No, that's correct. We have each debt service levy has a separate fund.
Right.
And whatever is collected for that particular debt service, whether it's the general obligation bonds, the general obligation bond has a separate fund. And whatever money is collected for that general obligation bond goes into that general obligation bond. It never goes into our district maintenance fund. Those are kept completely separate.
And I promise my last thing. So to make the assumption otherwise than what we just acknowledged would be wrong. I'm saying it's wrong. You don't have to say it's wrong. I'm saying it's wrong.
You can
Okay.
continue.
Okay. All right. Let's see. Where were we? Okay. So as you can see from this, our debt service funds, our total revenues, we are showing $2,846,464. And I'm sorry if I went over this before. I may be backtracking, but just want to make sure that I have explained all of this. Our total expenditures, we're projecting $4,436,284. That leaves a difference of $1,589,820. And this consists of funds that we currently have in fund balance in the debt service funds. These funds are by law to be used only for the repayment of debt. Because we have this in fund balance, we do not have to request this amount in our debt levy. Therefore, the budgeted revenue will be less than the budgeted expenditures. Okay, now we will go and look at our expenditures. They're on slide 14. Our budgeted expenditures are broken down by category. Our total projected expenditures are $44,418,149. This is a total increase of $1,893,087, with the majority of this being due to the teacher pay raise. The increases are due to the following. Instructional services, we are showing an increase of $909,620. This is due to the teacher pay raise and some new positions that we will talk about in a later slide. Support services, we are showing a projected increase of $467,554. This is due to the increase in salary for the new superintendent, some new positions that we will talk about in a later slide, increased expenses for care and upkeep of grounds, and extra funds budgeted for professional development. It also includes the $249,300 that was authorized to be spent out of fund balance for 3 buses at $83,100 each. This has to be added to our budget and taken out of this fiscal year. Our non-instructional services, we are projecting an increase of $239,167. This increase is due to increased participation in the child nutrition program, some new positions, and some parental involvement fund carryover from the prior year. We have no facilities acquisition and construction expenditures. Our debt service expenditures will increase for $246,746 due to an increase in principal and interest payments for the GO bonds. On slide 15, we have a pie chart that shows that the majority of our expenditures does come from instructional expenditures. On page 16, you will see our instructional expenditures are $22,233,406. The instructional budget includes all teachers, assistant teachers, salaries, and fringes. This also includes any expenditures related to instruction, such as textbooks, classroom supplies, dues and fees, and contractual services. On slide 17, we have a list of our new positions. We have an ACT prep teacher that will be funded out of Title II at Columbus High School, a math teacher that will be funded out of district maintenance at Columbus High School, 4 periods of music, which will be funded out of Title I at Columbus High School, a psychometrist or either a psychologist that will be funded out of local special education at 70% and federal special education at 30%. This will be located at Hunt. An elementary teacher that will be funded out of district maintenance for Sale, and an elementary teacher that will be funded out of district maintenance at Stokes Beard. On slide 18, you will see our elementary budget for instructional purposes is $8,887,809. The district maintains 5 elementary schools serving pre-K through 5th grade. We offer pre-K at all of our sites at no additional cost to the parents of our community. We are projecting 2,475 students, 126 certified staff, and 43 paraprofessionals. And we utilize a magnet school concept at all of our elementary schools. Slide 19 shows our middle school instructional budget of $3,247,273. We serve grades 6, 7, and 8. We are projecting 978 students, 52 certified staff, and 3 paraprofessionals. We have an honors program, gifted program, support for our magnet school concept, team teaching concept, and STEM, which was Pathways to Learning curriculum. On slide 20, our high school instructional budget is $4,328,974. We have a comprehensive high school. We have technology labs. We have 90 Carnegie unit course offerings. We are projecting 1,200 students. We are also projecting 61 certified classroom teachers, 5 paraprofessionals. And we have advanced placement courses, IB diploma program, athletic activities, and ACT prep. On slide 21, our gifted instructional budget is $383,225. We have projected 5 certified staff. We serve grades 2 through 8. We are only required by law to serve, or by the state, to serve grades 2 through 6, but we do offer 7th and 8th grade also. We are projecting 350 students, and we also participate in Destination Imagination. Slide 22 shows our special education instructional budget in the amount of $4,026,684. We offer speech services. We are projecting 619 students, 54 staff, certified staff, 20 paraprofessionals. We offer services in all of our buildings and private placements. Slide 23 shows our alternative education instructional budget in the amount of $207,924. We have K through 12 alternative school. We have a juvenile detention center. We are projecting 4 certified staff, and we are projecting 85 students, although we never can tell with certainty how many students we will have at the alternative school. But the alternative school is required by state law. On slide 24, we have our vocational education instructional budget in the amount of $1,003,624. We have the Keller Technology Center. We have 10 career education programs. We are projecting 445 students and 14 certified staff. On slide 25, our other special functions instructional budget in the amount of $147,893. This consists of tutors at the Palmer Home, homeless tutors, ELL tutors, and dropout prevention. And then on page 26, this is our total instructional budget, $22,233,406. On slide 27, we have our support services budget in the amount of $14,712,914. This includes principals, administrators, librarians, nurses, counselors, secretaries, the business office, maintenance, and custodial staff, and other types of support for teachers and administrators. Slide 28, we have our non-instructional budget in the amount of $3,035,545. This consists of food service operations, where we have projected 49 employees, and our other non-instructional activities include the activity funds and parental involvement. Now we will discuss debt service. On page 29, you will see what we have debt service for. We have our general obligation bonds. These were issued for the middle and high school construction. We have our 3-mil notes, which were issued for the Stokes-Beard construction. We have our shortfall notes to cover a shortfall in 2011. We have our QZAB bonds that were issued to cover our Columbus High School 2008 renovation. We have our qualified school construction bonds that were issued to cover our elementary schools addition, and our MDA energy loan, which was issued to cover our lighting retrofit. And all of these, we have set a debt service levy for them, except for the MDA energy loan, as I shared with you earlier. This has to be paid out of our district maintenance fund.
Madam President, may I just, while we're at this point, could I ask a quick question?
Sure.
Ms. McGar, you were going through the debt service, and the shortfall notes for 2011, they'll be paid off this year. Is that correct?
I believe so. We'll talk about that in just a
Okay.
minute. I've got the ones that will be paying off on another
just,
screen.
Just so that I make sure I have my notes correct, in 2011, there was action taken. We declared a shortfall, but there was action taken to move $1.5 million out of the district maintenance.
That's correct.
Thank you.
Okay, on slide 30, you will see our debt service, what it is made up of. We have principal payments in the amount of $3,670,232, interest in the amount of $747,552, and other fees. These are paying agent fees that have to be paid to our paying agents in the amount of $18,500, which leaves our total debt service in the amount of $4,436,284. And this, Mr. Spears, this is the slide that I was referring to on on slide 31. This shows each of our debt service issues and when they will be, the ones that will be paying off in fiscal year 15. We have our GO bonds that were issued in 2007. We still have our principal balance at June 30th of 2014 is $1,287,000. We have principal and interest to pay in fiscal year 2015 of $1,310,487. This general obligation bond does pay off in this upcoming fiscal year. Our GO bonds that were issued in 2008, we issued $9,950,000. At June 30th, 2014, we still had a principal balance of $7,950,000. For fiscal year 2015, we'll have principal and interest payments in the amount of $818,313. Our GO Bonds 2009 series, the first of these, we issued $9,950,000. At June 30th, 2014, we have a principal balance remaining of $8,950,000. For fiscal year 2015, our principal and interest payments amount to $752,700. Our second 2009 series general obligation bonds, we issued $2,100,000. We had a principal balance remaining at June 30th, 2014 of $1.4 million. For 2015, our principal and interest payments will be $390,250. Our 3-mil note, we issued $6,500,000. At June 30th, 2014, we had a balance remaining on principal of $2,085,000. For 2015, our principal and interest payments amount to $476,338. Our 2011 shortfall note, we issued $909,818. At June 30th of 2014, we had a principal balance remaining of $309,597. Our principal and interest payments for 2015 will be $316,098, and this shortfall note will pay off in the 2015 fiscal year. Our QZAB bonds, we issued $2,500,000. Our QZAB and our qualified school construction bonds still show a principal amount remaining of the amount that we issued, because these are in what is called a sinking fund, and we make payments into the sinking fund each year. At the end of the term, whatever is in the sinking fund will be used to pay off these debts. So you will always show a principal balance remaining of what you issued, even though you have amounts in the sinking fund to cover what has been owed so far on those issues. For principal and interest for fiscal year 2015, we are showing $250,000 that will be owed. Our qualified school construction bonds, we are showing principal and interest of $58,200. And when we look at our debt service request for our tax levy, you will see that the qualified school construction bonds are not listed on there, because this fund, our qualified school construction bond fund, in 2011, as Mr. Spears has already addressed, $1.5 million was transferred from the district maintenance fund to this fund, and it has been sitting there ever since. Because of IRS regulations, we cannot pay on this debt any sooner than what it is due. So that money has been sitting in that fund since 2011. Also, the past 2 years, $250,000 has also been transferred into that fund the past 2 years. So I have not set a levy for that, because we have funds to cover the principal and interest payment of $58,200. The MDA Energy loan, we issued $293,815. We have principal and interest payments for fiscal year 2015 in the amount of $45,398. Our total fiscal year 2015 principal and interest payments is $4,417,784. If you add paying agent fees of approximately $18,500, and that is based on estimates based on what we have paid in the past, we will come up with our total debt service budget of $4,436,284.
Madam President, may I ask one question? Ms. McGar, just to reiterate, in 2011, shortfall notes were issued, and for an amount of $909,818, that was a shortfall for that year, correct?
That is correct.
And in that same year, action was taken to move $1.5 million out of the district maintenance fund.
That is correct.
Thank you.
Okay, if you will turn to page 33. We've already gone over page 32. On page 33 is our projected ad valorem tax request worksheet. And this is a draft, because these amounts will change. We are required by state law to submit this request to the city by August 15th. We have one more payment that we will receive for our debts, for ad valorem, and the amount, that portion of that ad valorem check that we will receive from the tax collector's office, the portion that is attributed to the debt service will be taken off of this debt service request. Also, the amounts at the top, we will be adding in our tax for estimated new property. That has not been added in yet. So these amounts will change. However, we are showing a decrease in our total request at this point of $366,759 from the prior year. We found out this week that the value of a meal has dropped, so we are trying to maintain a balance of meeting the needs of our children in our district, and also making sure we do not put an undue burden on our taxpayers. So we are trying to make it so that we will not increase any taxes to the taxpayers.
Madam President, I have a question about the ad valorem request, because I know we had our meeting on, was it Tuesday night with the city council and mayor and everyone. There was about $195,000 difference there as far as what we were seeing, and now there's $366,000. One thing, obviously, top line, if you kind of go from top to bottom, there's a difference of about, as I think you noted earlier, $57,000 ad valorem. I'm sorry, the homestead exemption, $291,750, 57.
We
And-
took that from an estimate that Mr. Greg Andrews has provided for
Right,
us.
and it would be that that we had collected this year. The state of Mississippi actually sends us the money. It's not something that comes from the local
That's
taxes.
correct, but it goes into this calculation.
Right.
And we have actually received for the 2013-2014 year, $341,000.
Okay, and it's my understanding that the calculation of that the number that we get is based off of the applications and several other variables that go into the equation to come up with how much we should receive. And so it's very likely that we as the school district may have received more than our share of it, and therefore it may that the state may have inadvertently sent us some of the actual city's homestead
I
collection.
can't answer that question. All we do is receive it from the state of Mississippi.
No, I understand that, but I'm just saying it's like that could be why there is a difference between X and Y.
Could be, yes.
Okay. The other thing that I looked down is that, we've changed that number, and as we go down to the as you just stated earlier, that we don't really have a calculation for new properties that would be on our rolls. Now, obviously, I know there's annexation project that's going on that may not necessarily affect us, but it is my understanding that where the Love's multi-million-dollar fueling facility is being built, that is in the city.
I'm not sure on that.
I mean, it is, and I was just going to say it is because it's not part of where it's being annexed. And then, of course, Hobby Lobby and several other things that would be coming onto the roll to add value. While we're losing some big parts of it, there are things that are kind of incrementally sopping up that slack. Now, to get to my point here, is that there's a decrease let me do the math here. Let's just call it $160,000 difference from the night from Tuesday to now as to what we're going to decrease our request. Inside of what we're requesting to pay, are there any changes? Are there any changes to the things that we're going to pay in our budget that we budgeted for? And those things that, because from my analysis, it looks like that now we're not going to request enough money to pay for textbooks.
Well, we have, the board authorized us to pay $500 and something thousand out of fund balance to cover textbooks. There is some additional funds that we do need for textbooks. This amount will be adjusted because I have not included our new tax on new property.
Yes.
So that will go into this calculation, and hopefully that will cover the textbook needs that, the additional textbook needs that we will need.
But it would be my understanding that if we do not request that money, that we lose it, and therefore it will come out of the district maintenance piggy bank fund.
That is correct.
To fund that versus doing what we are legally here to do, and that would be to make the request to provide adequate resources for the students. Is that correct?
If we do not ask for any new property and we left this just like it is, we would need to go into fund balance to cover our additional
Because,
textbook
I have a
needs.
great deal of respect for all the city parts that move and make this a city that functions, but we're not part of that equation. And so to fund textbooks with a budget request this year or not fund it because we may have external forces asking us not to, I think is not something that we should get into the cycle of doing. And so I would ask that as you have to go back and make your adjustments, that if we need textbooks to be requested in our request, and obviously I'm one board member and my vote may not mean anything, But I would just think that the public, if they're having to pay for what the school district's here to do, I think that they would want to fund those necessary parts and not get into a cycle of where we're just going through our district maintenance fund because we don't want to hurt other people's feelings that might be involved. So that's my statement. I think that if we look back through the numbers here, that you'll see that by us decreasing some of our requests, it's essentially saying that well, we're not going to request it, we're just going to take it out of district maintenance to pay for textbooks and other things that need to be done. And for us as a board to do that, we're not doing our responsibility as trustees. And I just want to make that crystal clear.
Madam President, and I know that I made the motion for the textbooks, but from the onset, I think that all textbooks should have been a budgeted item from the beginning. We spent $500 and some thousand for something that should have been just a budgeted item. So I'm going to go on the record as saying is that since we spent $500,000 on textbooks that should have been budgeted, then I don't have I'm just one board member, then I'm not going to have a problem spending whatever else we need to get some textbooks.
Okay.
Several questions.
Ms. Lightline.
I want to focus in on these various ad valorem worksheets that we have been presented with over the last several days. Tuesday night, when we met with the mayor and city council, the figure that was on the sheet was $13,037,724, and everybody, I think, left here thinking that that's what we were going to request. Today, we're looking at $12,866,403. A decrease from Tuesday night of $171,321, but what's on page 33 does not square with what's on page 7. In your slide that showed local revenue, that figure is $12,695,757, $170,646 less than what you're reflecting on
Homestead
slide
exemption
33.
is considered state revenue.
Pardon?
Homestead exemption is considered state revenue, even though it figures into the total request.
Well, what I'm looking at, as I said, is the $12,695,000 doesn't square with the $12,866,000. What's the difference between those two? Now, I did see that from Tuesday night until page 33, that you adjusted homestead exemption from $346,239 to $291,750.
Yes, based on amounts that we received from Mr. Andrews.
I understand that, but again, we have three different numbers for local ad valorem taxes, and none of them agree with one another.
Yes.
Can you explain the
I
differences
can.
for those three, please?
The ad valorem request, the portion that is covered in local sources is the amount of $9,849,293, and that is covered as local ad valorem. The $291,750 is included as state revenue. And also, the debt service portion, $2,846,464, that is included in local revenue.
I guess my question is, shouldn't the amount on the ad valorem worksheet agree with what's on page 7?
Page 7. No, it won't, because homestead exemption is considered a state revenue. It is not considered a local revenue.
And just to understand, that's why that we received the homestead exemption money from the state and not the local tax assessor.
That's correct. But it goes into your ad valorem request worksheet.
So, Madam President, if I might, just as we're on this same worksheet page here, so it would be my understanding, while you has stated that there are variables such as new properties and other things that may apply to this sheet being altered and changed. And we're also looking into the details of how there was a discrepancy of about $57,000 that we as the district collected that is over what we should have collected, as to where that money should be Is it really ours? Is it should be returned to someone else, to the state or to the city? But my question is that our request on the operations side shall be increased to cover the full cost of the textbooks for this coming balance year, which simply means that as that goes up, that would be less than the 366 of a decrease.
What we are trying to do is we want to keep the tax burden on the taxpayers. We do not want to increase the tax burden on the taxpayers. And so the debt service portion, when we get our next payment from the tax collector's office, that will go into these, and these debt service amounts will decrease. However, we want to add or increase our operation budget by the amount that we need to fund our textbooks, while in effect keeping the overall tax burden on the taxpayers the same.
Right.
So whatever is needed, we will calculate our estimated ad valorem tax on new property, and we will try to claim enough new property to cover the cost of those textbooks. But we want to keep our overall tax burden on the taxpayers not any more than what it was last year, because not through any fault of the school, the value of a meal has gone down tremendously. Last year it was $204,000. It has been estimated that for the next year it will be $198,000. That is not, that's something that is totally out of our control. But we still need to meet the needs of our students, and we need to provide them with the best education that we have. So it is a balancing act between trying to provide what we need for our students and not placing undue burden on the taxpayers.
Well, one observation and calculation that I've looked into is that last year we based a budget off of $204,000 of a meal, and it was forecast to us that a meal should produce about $208,000 or $207,000, $208,000 in that range. My question to the board is, do we know what a meal actually produced? Because we were forecast at $207,000, $208,000. We were told to base the budget on $204,000. Do we know what the meal actually produced last year as to whether our calculation and usage of that number was on point, whether it was low or high?
Mr. Spears, I don't understand your question. I mean, I have,
Sure. So last year we were told that a meal should generate, let's just use $208,000.
I understand.
Okay? But we were asked to form our budget based off of $204,000.
I understand what you're saying.
Okay.
I don't.
So do we know what the meal actually produced last year? Was it 208, 207, 206, 204, 200, 190, 175?
Well, you got
Since
the man
I-
sitting in the back of the room that can answer that question.
Before,
Okay, Mr. Lewis.
before the man answers the question, since I've been on the board, I was told that a meal was $204,000, and that's just my brief moments being here. I also know that in one of our meetings, as Mr. Spears said at first, earlier, that in my opinion probably doesn't count, but I also said that a meal this year has been projected to produce $199,000 at one of our previous budget meetings. So what I'm saying is that the information that I have had has been echoed to this board. Now, what we made our projections on, I don't know.
So just and certainly I know we'll have that answer in a second, but the question is that this year the calculation was $205,000 and so dollars. That's what a meal should generate. And then backing off some of the things playing out in the city, we should base our budget off of $198,000. So it would be my question to the board is if there's the difference between 100 and let's just call it 205,000 and 198, that is about $7,000 difference.
Mm-hmm.
And if you say $7,000, and correct me if I'm doing incorrect mathematics, 7,000 times 65.87, that would give you a total number that if we based our budget off of 205 and we didn't go at 198, 205,000, or let's just say 204, that's what we did last year, 204,000 minus 198 is 6,000. Multiply that times 65.87, that'd be 395,000 and change.
That's
Right.
right.
That's right.
So if we base our budget off of $395,000 less, and we get to the end of the year, and we're wrong, and we should have based on 198, what's my understanding is that we have about $1.8 million that's sitting there that has been just sitting there doing nothing, that's not part of the piggy bank, that could be utilized to make our budget whole and not have to declare a shortfall. And as we go into the next year, we already know that there's a massive amount of debt leverage that comes off the budget, and therefore the debt, the burden on the taxpayer is abated at that point then. Would that be correct?
That's
I,
kind of speculation.
I don't know, and like I said, I thought that at one meeting we said that the 1.5, 1.8, we were going to utilize it for something else. I mean,
Absolutely, but as far as where it's at now and decommitting it, it goes back into the general fund, and if we say, okay, well, if we're wrong, and our budget comes up, let's just say $400,000 short, $395,000, and we earmark $400,000 of that 1.8 and don't put it on paying off debt or anything else, and we're wrong, then we've got the money there that we don't declare a shortfall, and it pays off. It basically makes our balanced budget.
absolutely.
Is that correct? So,
I think at this time, Mr. Andrews, if you would not mind, if you would come and share with us exactly what the value of a meal from last year actually produced. And then I would ask the board that we allow Mrs. McGar to go through her presentation. I think there are some details that we can come back and talk about, but allow her to get through with her presentation.
Yes, ma'am.
Welcome, Mr. Andrews.
Thank you so much.
You're more than welcome. I think the question was, Mr. Spears, your question was you wanted to clarify what the value of a meal actually produced for last year.
Let me say this, okay? On every budget we've done since 1988, we've backed off $4,500 a meal. If a meal actually produces $205,000, we automatically back off $4,500 a meal, which that gives you a buffer at the end. You're talking about the buffer on the front end instead of the back end. Mm-hmm. I'd rather have it on the back end. And in the past, to answer your question, the meal produced $203,800 a meal for this past year. What we do is back off $4,500 a meal on each budget. So we'll, at the end of the fiscal years, we'd have more than enough money and don't declare a shortfall. This year we backed off $7,000 a meal. I think it was May the 13th, we told Tammy and Ms. McGill that a value of a meal was worth $200,000. At that time, that's what we had thought. You have $8.4 million in your packets that I gave each board member. You have $8.4 million rolling off of Sanderson Plumbing, who is out of business and bankrupt, and you have $8.2 million rolling off of Omnova, which they're in the process of going out of business. So that $16 million represents about $2.5 million assessed value, which is another $2,500 per meal. And if you notice on the letter, I don't care whether you set the value of a meal at $210,000 or $100,000. I don't care. It says in our opinion, you should use $198,000. The reason that $198,000 is in there is because of that $4,500 buffer that is a normal thing since 1988, and the additional $2,500 mil because of Omnova and Sanderson Plumbing. And if y'all choose to use for 204, or if y'all choose to use 205, you will be getting that reserve money out of that $1.8 million at the end of the year. You will be. And next year, not to just be the bearer of bad news, but I was asked yesterday, you've got an additional 8.8 million for next fiscal year that's going to come off of Sanderson Plumbing. You've got an additional 10.63 million that's coming off of Omnova because they will be at the end of their contract and removing all their inventory. You've got about 1.2 million coming off at Seco. That's just the stuff that we know even before we go into that next year. So you've got decreasing car tags. The budget is made up of real estate, personal, public utilities, 4 or 5 different things that make up that total value. You've got decreasing, the only variable in there is the car tags. It's based on what was done the previous 12 months. That previous 12 months has come and gone, so that car tag value is likely to go down when we are sitting here next year. So, you know, you're dropping from 205 to 198. It's my opinion that you should leave that 4,500 off of that total amount of the 205. I forget what it is, 205 something.
205.6.
205.6. It's my opinion that you should leave that 4,500 off of there. The 2,500 for the Omnova and the Sanderson Plumbing, you could address at the end of the term, at the end of y'all's fiscal year. That's just my opinion.
Madam President, if I might,
Ms. Spears.
obviously, you know that I respect, your calculations, so I'm not belittling anything that you have put out there and different things. And my question to you is, as it was outlined earlier, would it be problematic if we forecast everything as we did this past year, knowing that, hey, we're going to run short, but in like years past, we don't have to do a shortfall note because we have this money. And if you look at it from that, say, well, you'd have to declare a shortfall note, well, that's debt, right? We're decommitting it from debt.
That's correct.
Where it couldn't be used for debt. So if we reserve that to the side, knowing that there is the possibility that we're going to come up right at $400,000 short, that would leave a net of 1.1 or whatever it is, 1.2, 1.3, whatever the total number is. But then as we roll into the next budget year, which that's outside the scope of what we're doing here today, but let's just look because that was mentioned, we already know that this debt is peeling away, and so it should certainly soften the blow of any of those other issues that come down the pipeline in that tax year, correct?
That's correct, but I will bring up a couple more things, and like I said, and all y'all know about it is the Section 42 housing.
Right.
That y'all have before November the 7th. That's a federal court ruling right now that we're waiting on the federal courts to come back with. You have $131,000 sitting out there that you have collected that's in your budgets, and I guess 18 months ago I told y'all to set that $131,000 aside in a piggy bank because one day you might have to refund it if we lose that federal court case. We've lost it once. It's been appealed. So that $131,000 may have to be paid back by midnight November 7th, okay? And to address the homestead issue, it was set by the legislature last year that each entity would get 88.8% of their homestead reimbursement back. The county supervisors, the city, and the city is getting about 88.8%. Y'all are getting around 118%, 120% maybe. But that is virtually impossible because the way you get that homestead reimbursement back is number of applications, 5835 times 50. That gives you the 291. That is 100%. You're supposed to be getting 88% of that 291. So that is another variable in there that you might want to look at also. In our opinion, we said 198. I don't care what y'all use. But next June, May and June, don't come saying because we use 204 or 205, don't come to Greg Andrews saying, oh, we're $700,000 short. Because I'm going to tell you right up front, I told you 198.
Right. And that's exactly why I wanted to ask, is because while this money is set aside as it's decommitted, it could be in expectation that if we run short, then that money would be going to cover that difference, rather, because it's already been collected from the taxpayer.
Right. If you use anything less than 204, you're going to come up short,
Right.
period.
And then as we go this year and into next year, most
You've got
likely,
debt rolling off next year. If
Things
you
are gonna
through
get
this school
easier.
year, it's going to get easier.
Right.
Because of the debt rolling off.
right. And I hope you don't think I'm being adversarial with you. It's just, I look at it from,
I don't think you're being adversarial. I can be adversarial too.
right. But the point is that I really believe that as we do our calculation, is that if the problem is that, well, the mills are going to go up, we don't set the mills. We make a dollar request, and then you take that dollar request, divide it by what is the mill, which if you were to do that and say, okay, the mill was forecast, if we did full value, the mill was $205,600, you divide that by, let's just call it, if it changes to 13 million, that actually looks like the mills went down.
The request went down,
Right.
but the mills are going up.
Okay.
Yeah.
If you request, you have to add 120,000 for the collection fees, which we dropped from 5% to 2% 5 years ago, which 5 years ago you were paying $360, now you're paying $120.
Right.
So that we saved $240,000 just for my collection fee for the last 4 years. You have to add the homestead loss, which is on the letters that are provided to y'all,
Right.
to your request. Once David Armstrong and Milton take that figure and divide it by what a mill's worth, then that millage is going to increase.
Okay.
Ms. Lewis, did you have a question?
Just one final question to Mr. Andrews. Ms. Andrews, I heard you say that Omnova and some of those other companies are going to be coming off the tax rolls next year. So you're telling us now that there's a possibility that a mill may go down again next year?
A mill is going down.
Okay.
You have, and I agree with Mr. Spears too. You've got Dix and Michaels and et cetera coming onto the tax rolls that are brand new. But my position as tax assessor is, if you've got 20 million rolling off, you've got to put 20 million on to get back to zero. And you've got to add a lot of Dix and Michaels to get back to 20 million.
Well, thank you, Mr. Andrews, for answering those questions.
Thank you.
Mrs. McGarr?
Okay. We covered our debt, and if you'll look on page 34, I did our operation escrow amount. On page 33, you will see we're taking out $121,104 from our operating request. That is because we over-collected for operations for 2013, 2014. And that is figured up on page 34. You will see our total local source revenues that were budgeted as sent to the levying authority in the amount of $9,931,023. Less our total receipts for the year on a cash basis of $10,052,127, left an escrow for operations of $121,104, and that does go to decrease what we request for operations from the local taxpayer because we've already collected it. It is in our fund balance. On page 35, I've included a calculation of how I determined how much to ask for each debt service levy. At the top, we start with the 3 meal notes. I actually prepared this back in May, so I took the cash on hand at April 30th of $113,709, and we actually received in May $359, and then in June $403.57. I took those and then subtracted what we would need to pay out in principal and interest for the 3 meal note, as well as fees. We also receive a pledge from the state of Mississippi in the amount of $188,104. We do receive that every year as long as we have it pledged towards something. And then our interest to be paid in October of 2015, we go ahead and include that because majority of the revenue comes in the spring, so we go ahead and ask for that up front because the county's fiscal year is on a different fiscal year than we are. And so that leaves our total request for the 3-mil note of $206,430. Now, this will decrease some more based on what we receive for the month of June. We will actually receive it later this month. So I will adjust those amounts, and that will come off of that. But each of the debt levies I have calculated in that manner, so I won't go through all of those in detail. But that is how I came up with the ad valorem tax requested for debt service that you see on page 33.
Madam President, just one quick question.
Ms. Spears?
So our total amount that we need to pay this year under the debt side is about 4.4 million,
Yes, that's correct.
and we're requesting 2.8 million, which is a difference, we'll call it about $1.5 million and change. And that is because we're zeroing out the residue cash in these debt service accounts.
That's correct.
Thank you.
Because we already have those funds available, we do not have to ask again for those funds from the taxpayers.
And that was just in the past where, when we were making the request, or that those cash in the accounts were not accounted for, and they just requested money to pay whatever it is that needed to be paid. Thank you.
Okay, and then on page 36, there's just of course, this is a draft because these amounts will change. Our proposed budget ad valorem tax request of $12,866,403 compared to last year's request of $13,233,162, and that is a difference of $366,759 decrease.
And Madam President, one point of clarification, the $12,866,000 does not account for if we were to increase the operational side of our request to pay for all the textbooks needed.
We are actually hoping that we receive enough for the month of June that we will receive later this month to cover those textbooks. So we're hoping that this actually decreases some more.
And this calculation, the $12,866,403, is based off of what amount per meal? Which I know we don't set the millage, but if it came up with this request, we divide it by the number that we're using, it should give us what they would say would be the mills.
Yes, we would use 198,000.
Okay.
Okay, so we hope this presentation has been informative to you as taxpayers and supporters of the children in our school district. We do value your suggestions, questions, and comments, and want to provide everybody with an opportunity to give us your input. So when you arrived, you were given an input form, and we will now collect those forms from you and answer any of your questions that you may have. And I will let Ms. Verdale read these questions.
So this is the first one. It says, in a previous budget workshop, it was pointed out the tax burden is being reduced for about 2 to 3 years, and then will go back up to the current levels. Is that correct? And what's the reason?
In a previous tax budget work session, if we kept our debt like it currently is, and we did not use any funds to pay off any debt, we would see a decrease because we are paying off some debt. And then later on in future years, we have our qualified school construction bonds that the principal is going to be increased a lot more than it is now. And so there will be a jump in later years, but we currently have the $1.5 million that we transferred into that qualified school construction bond fund. We are recommending to our board that we use that $1.5 million to pay down the last 3 years of our 3-mil note. And we are also requesting that we have Mr. Jim Young from the Young Law Group come in, who was our debt counsel, and restructure all of our debt so that we will have it more consistent and it won't be a rise and a fall every year.
Sure, Mr. Hines.
That is just the way that it was set up. It started out, those bonds they have a very low interest rate, and it's in a sinking fund. So we're actually not paying off debt. We're putting money into a sinking fund, and the first few years, the amount's very low, but then later on, that amount increases dramatically, and that's just the way it was set up. I was not here during the time it was set up, so I don't know if they chose to do it that way or if that's just the way that those types of bonds are set up. But because of that, and I have a feeling that's probably why that $1.5 million was transferred over, because they knew that in later years that amount was going to increase. However, because of IRS implications, we cannot pay up front on that debt. We have to wait till it's actually due. And so we can't do anything with that $1.5 million. So in order to save the taxpayers' money on interest, we would like to use that money to pay down our $3 million note, which would save approximately $188,000 in interest.
The next question reads, slide 27 did not explain the increase in support services budget over 2013-2014.
Our support services, we are showing an increase because we do have a few, and I addressed this on one of my slides, that we do have an increase in some of the support services because we have a new superintendent salary increase, and the increase in that is approximately $90,000 with salaries and fringes. We also have some extra money that we are budgeting for professional development so that our teachers will get the best training that they can have for our children. We also have a few new positions in our budget, such as the psychometrist, the psychologist, and things such as that makes up the difference in that support services.
The next question is, what was the purpose of each GO bond issue?
Okay, the GO bonds, if you will look on slide 29, they were all issued for the middle and high school construction.
Next question. What was the purpose of the $3 million bond?
It was for the Stokes Beard construction on Stokes Beard Elementary School.
And what was the QSCB purpose?
QSCB, that was for the elementary schools addition.
And what was the purpose of the QZAB?
That was for the Columbus High School 2008 renovation.
Next question. Why was the $1.5 million moved from the district maintenance in 2011?
Okay, I've already explained that. And I don't know that for a fact because when I went back to look in the board minutes, there was nothing real, there was just a request to transfer that. Okay. That's okay.
So the next question, I think, is probably more of an administrative question. It says, how is homeless tutoring accomplished? How is homeless tutoring accomplished?
Madam President, Mrs. McGar, great presentation. Homeless tutoring is accomplished through a variety of ways. We have students that do require some extra assistance after school hours, and if the student does not receive special education services, any of our teachers that are certified in that grade level and are highly qualified, they can apply, and we do bring those names back to the board to be approved for after-school tutoring. Now, if a student does receive special education services, those teachers have to be certified in that disability area, and they have to be willing to go into the home to provide that added resource. So it does come out of special education funds if it is a special education student, or it does come out of district funds if it is a student that does not require special education services.
Okay, thank you, Mr. Shannon. The next question reads, Mr. Spears, in prior meetings, said that the special expenditures requested earlier, if carried over to the next fiscal year, would translate to a millage request. My question is, why then could it be budgeted out if the fund balance, if it is decided to do then without transfer to millage? And I hope I've captured this question, and I apologize, I'm trying to read. So did I capture the essence of the question?
Okay, could you clarify
Mr.
that,
Hines?
please? Mhm.
If you have a reserve, thank you, in your maintenance fund, why can't you, like you have done some of these things, just straight budget it right out of that maintenance fund rather than, quote, transfer it to millage?
The fund balance reserve is an amount that's built up from prior years, and if you keep spending out of it, eventually it will go away. Mhm. That is completely up to the board, yeah, and anything that's spent out of fund balance has to have board approval. We can't just spend out of that. Mhm. Yes.
Madam President, if I might
Mr. Spears?
address the question. One of the things is that, as far as an increase in millage, that would not be us. It would be an increase in our request dollars and different things, sure, which would ultimately, depending on how, you do your divisor, come up to a higher millage request if that's the case. I look at it that if the school district needs books, if it needs facilities, if it needs different things, well, these were brought to us, they're something that we need, then we should fund them. If we didn't fund them out of fund balance because we were worried about, we're going to deplete the fund balance, I understand that. They should go in the budget. And as you can see, they're not in the budget, they weren't funded, so they're just not going to happen. Sure. Sure. Sure.
So the next question reads, and Mr. Hines, you might have to help me out. It says the other state revenues is projected to increase plus or minus 47%. What is the history to justify the expectation?
In past years, our other state revenues, nothing was budgeted for national board reimbursement. Some of our teachers are national board certified, and because of that, they receive an extra $6,000, and that has not been budgeted, or that was not budgeted in the prior year. And so that is revenue to our district. It is a reimbursement to our district, and so I have included that in that. And that is why we have an increase.
Thank you, Mrs. McGard. That completes all of the questions that we've received. Are there any other questions this morning? If not, thank you, Mrs. McGard, for your presentation, and thank you for the work of you and your office. Board, if there's nothing else that comes before us at this time, I do declare this meeting.
Well, we do have some
What else?
questions. I just have one
You
question.
oh, you have one
We'd asked
question?
about it earlier. The difference between the homestead collection amount that we've been sent, I assume that we're looking into finding out why there was that overage and what needs to happen as far as going, whether it needs to be sent back or somebody because it is my understanding, and correct me if I'm wrong, that this wasn't an error that we created.
No, we did not create this
And
error
so
at all.
therefore, it's something that as we reach out to the parties that it initiated with, we could find out, okay, well, what's the resolution that we need to come to?
I can follow up
Sure.
on it, and, but no, it is not an error by the school district at all.
No.
We just receive whatever the state of Mississippi sends us.
Right.
And, so I don't know why in the past it's been like that, but yes, I can follow up on that.
Well, I appreciate all parties for catching it, because we don't want to be holding other people's money.
That's correct.
All right, Ms. Lewis?
If I'm not out of order, Mr. Andrews, do you know who we can contact to find out that information?
I would start with Gina Briscoe. She's the head of Homestead Division. Her number is 601-923-7600. I believe her direct line is 7622.
Jenna Brister? Okay.
Thank you.
Thank you, Mr. Andrews.
And Ms. McGar, would you, after you find something, if it's between now and our next meeting, would you bring that back to the board?
I will.
Let us know the outcome. Thank you.
All right, thank you again, Mrs. McGar. Thank you, board. Thank you to the public. If there's nothing else, I do declare this meeting adjourned.